Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, US senior care crisis fuels careflation with a 7.7% price surge, threatening the Fed's inflation fight and US economic growth. We'll explore how this critical labour shortage is quietly shrinking the US workforce and complicating the Federal Reserve's 2% inflation target. Second, Venezuela's 548% hyperinflation eclipses US military threats as the Bolivar's collapse creates a Venezuela discount in global oil markets. Today, we'll take a closer look at the dual pressures from US sanctions and China's shifting investment strategy and their implications for the regime's survival. Third, a $90 billion debt binge by Google, Meta, and Amazon to fund the AI race tests. Wall Street's limits signalling a major financing shift. We'll analyse why rising new issue concessions on these bonds matter now and how they could give investors veto power over the AI arms race. By 2034, there will be more seniors in this country than children. That single statistic from the US. Census Bureau is the fuse for an economic explosion in the senior care industry, but not in the way you might think. This isn't a story about a boom, it's a story about a crisis. An MIT economist is now warning of a critical labour shortage as the demand for care skyrockets. The numbers are staggering. The US is facing a projected shortfall of 4.6 million caregiving jobs by 2032. The labour gap in long-term care is already more severe than in any other healthcare sector, down over 7% since 2020. Interestingly enough, this isn't just a domestic labour issue, it's also deeply connected to policy choices, specifically around immigration. When we place the US restrictive stance alongside what other developed countries are doing, the contradiction becomes clear. Germany, for example, recently passed its Skilled Workers Immigration Act to make it easier for foreign caregivers to enter the country and fill these critical roles. This creates a direct conflict. The goal of managing immigration is clashing with the need to control inflation and staff essential services. And at the core of the conflict is pay. According to the Bureau of Labour Statistics, the average home health aide earns just $16.82 an hour. That's barely more than the average fast food worker for a job that is physically strenuous and requires specialised training. So what does this shortage look like in real time? One financial planner described seeing nurses at an assisted living facility wheeling residents into the dining hall at 10:30 a.m. in the morning, a full hour and a half before lunch was served. The reason? The home simply didn't have enough staff to get everyone to the tables at noon. This is creating a massive, unforeseen market strain. The CEO of Care.com now calls senior care a $200 to $300 billion per year category and has become the company's fastest growing segment. As demand surges and the workforce dwindles, prices for nursing homes are already rising faster than the rate of inflation. So the thing is, this matters for everyone's wallet. This isn't just about prices going up for one service. Economists have a name for it, careflation. And the data backs this up. The Consumer Price Index for services for the elderly and persons with disabilities has been rising sharply, jumping 7.7% in 2023 alone. That's significantly higher than overall core services inflation. This specific persistent inflation makes the Federal Reserve's job of hitting its 2% target much harder without slowing down the entire economy. This market boom has attracted a flood of investment, but it's created a paradox. While private equity is pouring money into the silver economy, the results aren't always positive. A troubling report from Florida, for instance, found that after more than 400 nursing homes were acquired by new owners, many of them private equity firms, the number of top-rated facilities was cut in half, while the number of the lowest-rated facilities more than doubled. This highlights a serious risk, a business model that prioritizes profit by keeping wages low, which can lead to high staff turnover and a decline in care quality. The situation has become so dire that one MIT economist states the crisis is no longer just a social issue, it is a direct drag on the nation's economic growth. So what does that drag actually mean? Well, it's a hidden cost that ripples through the entire economy. When professional care is unaffordable or unavailable, the burden falls on families. Research from the San Francisco Federal Reserve shows unpaid family caregivers provide on average 24 hours of care per week. To do this, many have to reduce their work hours or leave the workforce entirely. This is now showing up in a key economic indicator, the prime age labour force participation rate. A dip in this rate, especially among women, suggests that the care crisis is quietly shrinking the available workforce and hurting the country's GDP potential in a way that headline unemployment numbers don't capture. This crisis is colliding with another slow motion problem, the financial health of programs like Medicare and Social Security. The same demographic shift driving the care crisis is also straining these funds. The Congressional Budget Office already projects that Social Security's trust funds could be depleted by 2034, with Medicare's hospital insurance fund following in 2036. For investors, this means keeping a close eye on that prime age labour force participation rate, tracking careflation in CPI reports, and paying attention to any policy discussions around immigration and Social Security reform. These will be the focal points that determine whether this crisis leads to a broader economic reckoning. From a slow-burning crisis straining the US economy, we now turn to a full-blown economic meltdown abroad. The United States government has deployed the world's largest warship and thousands of troops to within striking distance of Venezuela. But on the streets of Caracas, the real war is being fought in the grocery aisle. The situation presents a fascinating duality. On one side, massive US military hardware is poised near Venezuela, while on the other, the global oil market's reaction has been nothing. No spike in oil prices, and that's despite Venezuela sitting on the world's largest oil reserves. The market's non-reaction is a powerful signal that Venezuela's production has fallen so far that it's no longer a major player. This is what analysts call the Venezuela discount. The country's influence is already priced out, making the internal economic crisis far more immediate than any external threat. While headlines focus on military threats, the nation's currency, the bolivar, is in a freefall, set to lose 80% of its value this year alone. One market vendor put it bluntly, what's really troubling us is the rise of the dollar. You know, when a local currency collapses, people naturally flee to a more stable one, like the US dollar. This process is called informal dollarization. However, the situation is more complex than it seems. While the dollar is a benchmark for prices, recent data shows a surprising reversal. The actual circulation of physical US dollars has dropped, and more than 80% of transactions are now happening in the devalued bolivar again. This is partly because the government has intensified its crackdown on the parallel or black market for dollars. So, while citizens feel the pain of prices set against the dollar, they are forced to transact in a currency that is rapidly losing its value, trapping them in an inflation spiral. The numbers are jaw-dropping. The International Monetary Fund projects a 548% price increase this year. To put that in perspective, a single kilo of chicken now costs about 4 times the official monthly minimum wage. One retiree told reporters she couldn't afford to panic buy food, saying, "You need a lot of money to do that." While there are many reasons for this, we can't ignore how US sanctions are acting as a powerful amplifier. They may not be the root cause, but they've choked off Venezuela's oil revenue, its primary source of foreign currency. For example, the Trump administration recently revoked a key license for the oil giant Chevron and imposed tariffs on any country buying Venezuelan oil. With fewer dollars coming in, the government's ability to support its own currency evaporates, the bolivar's value plummets, and the cost of imported goods skyrockets for ordinary people. But that's not the whole picture. The IMF warns that by 2026, inflation could soar to a staggering 629%. This economic collapse creates a paralyzing fear that has nothing to do with warships. One merchant, speaking anonymously, admitted, "We're scared, silent, afraid they'll throw us in jail. You don't hear anyone talking about it." Here's where it gets interesting though. This level of economic pain can lead to something counterintuitive: political apathy. Economists sometimes use a misery index, which adds the inflation rate to the unemployment rate. In Venezuela, this index is off the charts. When survival becomes a full-time job, there is little energy left for political protest. This challenges the common assumption that economic hardship automatically leads to revolution. The fear this merchant describes is very real. Reports from human rights groups indicate there are still over 1,000 political prisoners in the country, creating an environment where silence is a survival strategy. This brings us to a critical player whose actions may be more decisive than any warship: China. For years, China propped up Venezuela with massive loans for oil deals. That has now changed. Beijing has become much more cautious, shifting toward direct investments in specific oil projects. This makes China's financial decisions a critical indicator of the regime's viability. Beijing's strategic patience, or lack thereof, will likely have a far greater impact on Venezuela's future than Washington's threats. For the people on the ground, the most pressing threat isn't an invasion. As one man looking for goods to resell stated plainly, the core conflict is much simpler. Inflation is eating them alive. Speaking of international players and strategic maneuvering, the battle for global dominance is just as fierce in the tech world. And get this, 4 of the biggest names in tech just flooded the bond market with nearly $90 billion of debt in a matter of weeks. Google's parent, Alphabet, Meta, Oracle, and Amazon are on a borrowing spree, and it's all to bankroll the AI arms race. For years, Silicon Valley giants funded their biggest bets with mountains of cash. That era is over. The AI build-out is so massive, it's now being financed by the public debt markets. A while back, we talked about corporate compute sovereignty, spreading bets across chips and clouds. This borrowing binge is the financing layer for that strategy at hyperscale. However, if you zoom out, you'll see another layer of strategy at play. In the United States, the AI race is being funded by the private sector, which means these companies are now exposed to the risks of the financial markets. Contrast that with China's state-directed model, where the government can launch massive national funds to support its AI goals, creating a more stable long-term funding pipeline. It's also why Europe keeps pushing sovereign AI, trying not to be boxed in by US controlled stacks. This year alone, these hyperscale companies have racked up over $120 billion in debt. To put that in perspective, their average for the past 5 years was just $28 billion, and Wall Street is starting to get nervous. The question is no longer just about the promise of AI, but about the market's ability to absorb this tsunami of new bonds. As one portfolio manager at Wellington Management Company put it, the market has woken up to a new reality: AI won't be funded by free cash flow. He says there's a recognition that money may need to come out of stocks and into bonds to finance this. Now, this decision to use debt brings both huge potential and inherent risks. When companies take on massive debt, their future costs go up, putting pressure on their profitability. For tech stocks whose prices have been driven sky high by the AI narrative, this is a reality check. If the cost of building AI becomes too high, those exciting growth stories could face a major reevaluation. As we've discussed before, AWS and other cloud players have already felt margin pressure. Debt just tightens the vice. The spending is only accelerating, and we're already seeing signs of strain. Projections show AI capital expenditure could explode to $600 billion by 2027. To get their recent massive deals done, companies like Alphabet and Meta had to pay investors a premium over their existing debt, a clear signal of growing unease. In the bond world, this premium has a specific name: the new issue concession. Think of it as a discount to entice buyers. When this concession gets bigger, it's a real-time signal of investor fatigue. It's the market's way of saying, if you want us to keep buying this much debt, you'll need to make it more attractive for us. This effectively gives bond investors a kind of veto power over the pace of the AI arms race. But the situation takes an even more complex turn when you look at the AI value chain. We're seeing a major split. While these cloud giants are piling on debt, their key supplier, NVIDIA, is doing the opposite. NVIDIA's gross margins are soaring into the mid 70% range, while the cloud providers are struggling to stay in the 60s. This suggests the real surefire profits are in making the picks and shovels for the AI gold rush, not necessarily in running the gold mines themselves. And even with early cracks in its near monopoly like OpenAI testing AMD's Instinct GPUs, the profit pool is still gravitating to the picks and shovels side, which is exactly why regulators are circling. While these companies remain financial powerhouses, a fundamental shift is underway. The race for AI supremacy is creating a debt dilemma, testing the limits of the bond market going forward. The key indicator to watch will be those new issue concessions. If they continue to widen, it could force these tech giants to slow down their spending, which would have ripple effects across the entire tech industry.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.